The following is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
All right, it is Tuesday morning. We've got our major indexes kind of struggling there to hold on to any gains. Greece is the word, and I think looks like that's going to be for quite some time here. So what I've put up in front of you there is a chart for something having nothing to do with Greece. It's the chart for, I doubt they even have any of them in Greece. It's Arctic Cat. They make those ATVs and snowmobiles. I don't think they're using too many of those anywhere in Greece. But this company, the reason I have that up there, it fell as much as a little more than 17% this morning. It's made up some of those gains. The reason I'm showing you this, you're probably like, Arctic Cat, who cares? We've got Greece. We've got Europe. We've got a bunch of charts up there that don't belong. So I hope the charts look okay there on Tiger TV. Producer Al will let me know if we have a problem. But Arctic Cat is a small cap ATV maker. It reported its quarterly earnings this morning. It had been showing some good chart action as it consolidated. However, it issued guidance for fiscal 2013. It just reported its 2012 first quarter. It issued guidance that called for earnings below analyst estimates, revenues just in line. And, companies, even the stock can get punished even if the revenue is in line, the revenue views. So it really doesn't take much, and the reason I put this up there is just to show you that despite all the global news, the frankly, what I really do term the hysteria going on, the indecision, you are still seeing where earnings can make a difference in a company. Now, this is not one that I had on any of my watch lists. We just launched the newsletter, the Low Price Leaders newsletter, just a few weeks ago. We've got a new edition that will be coming out tomorrow, late afternoon, after the close. And this is not one that I had been particularly watching anyway. It was a little bit erratic when it came to the fundamentals. Now, I need to explain here for folks who are new to this show, the Small Cap Roundup, and the newsletter that we have that accompanies this show, the Low Price Leaders newsletter. I do not use fundamentals to pick my buy and sell entry and exit points ever on a stock. I rely on charts for that. The fundamentals, though, I do use as screening mechanisms. And what I mean by that when I say fundamentals, I really mean the earnings growth, the revenue growth. I want to see earnings that are driven by revenue, not earnings driven by cost cuts. And as we've said on this show many times before, the smaller caps that we look at here, those do frequently tend to show good earnings based on sales growth. As one of the fund managers we had on as a guest on the show recently pointed out, you often don't have these smaller companies, they don't have a lot of room to be cutting the fat, to be laying off people, to bolster earnings growth. So you really are seeing a lot of these smaller companies that are driven by revenue, and the earnings attracts the institutional investors. I'm going to, in a moment, bring on a caller, but before I bring him on, I want to just tell you, we have in the second half of the show a fantastic guest. We have fund manager Tom Lamming will be joining us, and I forgot to tell Al about that, so Al is going to kill me, but I'll get Al his phone number here in just a few minutes. I will get Tom Lamming on the line. And he is going to talk about some of his small cap picks. He's a fund manager over at Scout, so we will be talking to him, and he has some terrific stocks to talk about. Really looking forward to that. So let's bring right now, I understand we have a very special caller on the line, and some of you will probably recognize his voice. We have fellow TFNN host Larry Pesavento on the line. Larry, great to talk to you.
Hey, Kate, how are you?
I'm doing well. How about you?
Pretty good. I just wanted to alert the folks about, things we talked about on the show yesterday. We were looking for the market to bottom today and possibly rally into, for the Facebook thing on Friday. But we've had some real serious things happen today. First of all, the euro has broken decisively below 128. Now, we're down 11 days in a row. The dollar index is going above 81. I mean, we are really close to melting down in the stock market. I've posted a chart from 1987 showing the relationship to where we are now. And I'm not saying that's going to happen, but I just think the folks should remember that, all the markets in the world are heading down. The Bradley model is heading down. Stock futures are heading down. All futures commodities, I mean, with the exception of natural gas, which had a little bit of a rally, but you're looking at cattle, hogs, sugar, cocoa, soybeans, corn, wheat, gold, silver, all of them have broken down badly, much like they did in 2008. So I'm just telling the folks, if they want to buy, make sure they put a stop in and be careful, because we could be at a point where this thing just comes in some morning and it's not going to be where you think it is. So, just keep in mind, just a little warning, okay?
Yeah, Larry, I agree. I do not buy in downtrending markets, ever. I just don't. And I normally even, that we have not put on any new buys in the newsletter, so I'm agreeing with what you're saying here. It's, and I would probably even take the cautionary note a step further when it comes to longs. Just don't even try to play beat the market, because you can, it's way, way too easy to get taken down, because most stocks do trend along with the market. I mean, Larry, that's a point that I make repeatedly as well. Your tagline of trade what you see, I subscribe to that as well. Do not try to fight the trend. It's way too risky.
Yeah, there's just so many things lined up this time with, everything falling together. It's real scary. So I just wanted to tell the folks to be careful.
Great. Well, Larry, thank you. I concur with that cautionary note. I agree with you. All right, Larry, thanks for calling in. Good to hear from you.
Thanks a lot, Kate. Bye-bye.
All right, bye-bye. Yeah, that's I completely concur, and it's even without knowing what, even if you don't watch the news, if you don't go online and read the news, if you don't listen to financial commentary, if you never turn on the financial TV channels, you can watch what's going on the charts, and you can see the downtrending market, and that tells you that it's not time to get in. And that this downtrend has been confirmed by heavy volume selling. It's nobody's guess. I don't go on opinion. When I'm looking at these, I do not go on any sort of conjecture or watching what maybe some analyst predicts. And I know there's just a whole lot of that out there. Sometimes they're right, sometimes they're wrong. It's very easy to say when they're wrong, they were just early. That's I've recommended a book on here numerous times by James Revshark Depor, Shark Investing. And that was one of the funny points that he has made in his book, was the fact that if some of these if any of these market prognosticators are wrong, they can say, well, I was just early, because eventually the market is going to turn. We're in a downtrend right now, but historically, hasn't every downtrend been followed by an uptrend, and vice versa? Okay, so absolutely, we're not putting on any new buys right now in the newsletter. We do have 3 trades on, and we are watching these closely. They have not hit their trigger points, and if they do, I will send out a sell alert about that. It has not yet occurred. They're holding up. And, that is one of the things that remains fresh in my mind from 2008 and 2009, is back in those days, I was with Investors Business Daily. I was doing a daily video called the Daily Stock Analysis. And during that time, if you follow IBD at all, you do know that it does focus on longs. And I was constantly on the lookout for stocks that could be good watch list candidates that were showing that requisite combination of the fundamentals, the earnings growth driven by revenue growth, good chart action, holding up better than the general market. And wouldn't you know it, many of these stocks that we were tracking during that time as the top technical performers were the ones that were some of the first ones out of the gate when that new rally began in March of 2009. And, of course, the same thing happened back in 2003. 2009 is just very, very fresh in my mind, and particularly because I was creating a lot of this content back then. But, yeah, so we're going to just keep tracking these top performers. And we have the chart I have in front of you. Arctic Cat is not one of them. That is not one of those top performers. But just to show you that earnings does nonetheless, despite all of the negative indicators, some of which that Larry was talking about right then, some of which you can just easily see by following the news, that despite all of that, earnings are continuing to make a difference in how some of these individual stocks are acting. So what I was going to do here, I've got a couple minutes left. I want to start. I'm going to put up some charts here of some of these companies that are reporting earnings this week, and I'm not talking about some of these bigger names. I know we had Home Depot, but we don't talk about, we don't focus on, not that we don't talk about, we do talk about Dow components on this show, of course, but we don't focus on those, this being the small cap show. So I put up a ticker there, ABMD, a biomed, and this is one that I have had on some of the watch lists that I've been looking at. I'm going to put this up here on a weekly chart for you. I began with a daily. I'm going to put it up on a weekly. Okay, there you go. So I'm really liking how this is holding up very nicely above its 10-week moving average. It's actually consolidating in a fairly orderly fashion recently. Now, this is they make medical devices, cardiac devices, and that's quite a big product category lately. And that's something, let me just take a look here. I'm looking at some of the fundamentals. Double-digit revenue growth over every quarter in the past 2 years. Now, this company is forecast to become profitable in 2012, so after it does report, analysts see earnings of 3 cents a share this year. Now, it's not uncommon for a lot of these medical companies, biotechs, device makers, medical device makers, a lot of these heavily R&D dependent companies to not be profitable as they ramp up. But this is an interesting one to watch. I'm liking what I'm seeing on the chart. I like the fundamentals. Due to report earnings a little later this week, I think on tomorrow. Due to report tomorrow. So that'll be an interesting one to keep tracking. Market cap of pretty small, about $890 million. Okay, back in a few.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks, Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her Small Cap Roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now. It's that time of year again, and the Great Panther Silver Summer Silver giveaway is back. Every day in June, Monday through Friday, we'll be giving away a Great Panther Silver 1-ounce silver bar, and all you have to do to enter is visit the front page of TFNN.com and fill out your entry. Great Panther Silver and TFNN wishing you a great start to the summer. Sign up today to have a chance to win a 1-ounce silver bar during the Great Panther Silver Summer Silver giveaway the whole month of June at TFNN.com.
This segment is brought to you by Backtech Environmental. For more information, just click the Backtech banner on the front page of TFNN.com.
All right, we've got a segment here before we bring on our guest, Tom Lamming, and I'm very excited to hear from him. He is a small cap fund manager, and I talk about, and most of our listeners, I think, we really understand the usage of charts. Most of the fund managers, they really are fundamentally driven. In fact, I had asked Tom about that the last time he and I spoke, and he did confirm that. That's not unusual. There are a lot of reasons that the fund managers do tend to be more fundamentally driven, and while we don't need to make our buy and sell decisions the same way they do, it is instructive to hear what they're entering, because they do like earnings growth driven by revenue growth, and they will take a position often sooner than a retail investor has to, and often will hold it through a correction where perhaps we don't have to, but their buying is what does drive the price higher and indicates to us where our entry points can be, and also where we might want to do some selling. Okay. We had a question here from Axeman in the Tiger Den, and one of my friends in there that I communicate with frequently in the Tiger Den, asking about www.web.com. Now, this is an online marketing website, e-commerce service provider. You can outsource all of that to them. They focus on small and medium-sized businesses. Now, just taking a look, this is one I've been tracking this for a while. This has been one of my watch list candidates, and I've got a weekly chart up there on Tiger TV. I do like the little pullback from the recent high right there, quite healthy, holding in a very nice range, and I've just put it up there. Let me see here if I can get this on a daily chart. I hope you can see that there. So that I've just put up a daily chart for web.com group. You can see it's holding up very nicely above that 50-day moving average. Now, what happened here, this one did make a nice leap higher, it did clear its previous high. So over there, I'm indicating over there on Tiger TV, I've got the cursor. You can see that prior high that we were looking for it to clear. However, there was some market weakness at the time. And as if you heard in the first segment of the show where we had Larry Pesavento calling in, making the point that we are in a very weak market right now, very risky, very dangerous to get into stocks. I am not making any new buys at the moment. So this is not a stock I entered, not based on anything wrong with the technicals itself, but just based on the general market condition, because about 3/4 of stocks or more in a market like this will follow the direction. You do see here it is following the market direction. So let's see. So I'm looking in Tiger Den. Axeman just posted they raised more cash. Okay, that indicates that they have some projects, some growth they want to finance. You know, I'm not going to make a buy based on fundamental news right now, because really the general market and the chart are telling me not a time to be getting into this. Is it a good sign they raise some cash? Yeah, that's a good indicator. That does show you that some of the investment banks, the institutions, do have confidence in this company and are willing to finance further projects, further growth. So that is a good sign. Let me just see here. I want to take a look at some of the fundamentals here. Okay. We have double and triple digit earnings growth over the past 2 years. We do have the pace of revenue growth has been increasing over the past couple of quarters. So you do have some good signs when it comes to the fundamentals, when it comes to the story. So I'm liking all that, and that is all of those are arguments in favor to continue watching this. The chart is also an argument in favor of continuing to watch this. It's really consolidating very nicely, getting very nice support above that 50-day line, not melting down along with the market. And that's kind of what I was talking about a little bit in the first segment, about tracking these names that are holding up even while the market is just performing dismally. Those names that are holding up better can frequently be some of the ones to watch. So I like this one. I'm not buying it right now. You might see more breakouts in many stocks as the market even is in a downturn, but it's not unusual to see even breakouts fail because they get pulled down along with the general indexes. So good question. Glad you brought that up. That's a nice stock and one that I have been tracking and will continue to, more than likely, if all this continues to hold up. Stick around. We've got Tom Lamming from Scout Funds, small cap investor, coming up after the break. This is the Small Cap Roundup. I'm Kate Stalter.
What you think about, you bring about. What you focus on grows. If you're committed to becoming an extraordinary trader and investor, then make mastery your outcome. Yes, my best student, Steve Rhodes, became my best teacher. But even more important is what he's taught me, and the time is now for you to take advantage of his knowledge.
Thanks, Tom. I've learned that it's not what we do once in a while that shapes our lives, but what we do consistently. I want to teach you the consistency that exists in the stock, futures, forex, and commodity markets day in, day out. For one solid day, Friday, May 18th, I'm going to conduct an online master trader course that'll teach you how to buy and sell the D point. This one pattern alone, with the single best entry and exit techniques, when combined with my money management strategies, will create extraordinary rewards for you and your family. The course will be archived so you can review it as many times as you'd like, and it'll teach you to become a master. All the details are on the homepage at tfnn.com. Sign up today, because mastery is one click away. It's your decisions, not your conditions, that determine your destiny.
Wow! Go get 'em, folks.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations, including price targets and price stops. As recently as March 21st, Market Insights subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, Your Ultimate Trading Mastery System, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Welcome back. This is the Small Cap Roundup, and as I've been talking about in the first half hour of the show today, one of the things that is very, very instructive is to hear what some of the fund managers, how they view the market, how they view the stocks that they're trading, or actually they would probably prefer to say investing in rather than trading. We'll find out about that. But today I have on a terrific guest. As most of you know, I also do a lot of work with MoneyShow.com, and a few weeks ago I had the pleasure of speaking with our guest today, Tom Lamming, who is the manager of the Scout Small Cap Growth Fund. Did I say the name of the fund right there, Tom?
That's correct.
Okay, well, thank you so much. Great to be talking with you today, and thank you for joining us on the show.
Well, thanks for having me, Kate.
Did I characterize that correctly, that you would prefer to say you are investing in these small caps rather than trading them?
Yes, no, absolutely. Certainly the way I view companies, they're not, I think there's a class of investors that view them as pieces of paper. The reality is they're managed by people, and they have certain business models and products, and you kind of have to dig into that, and I think you own those. You don't just rent them, so.
Mm-hmm. Well, say a little bit about, we were talking a little bit earlier, before we got you on the line, we were talking a little bit earlier in the show about some of the economic conditions that are going on right now, and why a lot of investors and traders are quite worried about what they're seeing out there. Give us your perspective on the economy right now.
Well, job growth is incredibly weak. In the long run, that's what really matters because it's people producing things, not just material things. It could be software, it could be media, but producing things and then ultimately purchasing them. And that's really the essence of economic growth. Employers, I think, have been, could be inadvertent, but for whatever reason of the policies have been disincentivized to hire, I think. Mm-hmm. And so when we look back over the last 10 or 11 years, there's been virtually zero net employment growth. There's no more people working today than there was at the beginning of 2001. Now, when you contrast that with, and of course, that's one reason for the high unemployment rate. We started with a low unemployment rate during that 11-year period. We're now at the high one. Yet GDP has grown by $5 trillion. And that's about the equivalent of the GDP of China. So we've added the GDP of China to our GDP in the last 11 years, and we've done it without bringing on a single worker. And there's a number of reasons for that. I'm obviously very concerned, and one of the things we try to do from an investment standpoint is recognizing that companies are substituting capital for labor. I mean, how do you grow GDP by the size of China but not bring on any new workers? And you do that by buying a lot of equipment. And so we focus very hard on the technology and industrial areas. That's where we think we, certainly has been and there will be the best opportunities.
Mm-hmm. And, certainly this is way out of the scope of what we have time to talk about today. But, in addition to policy and politics, which we're not going to talk about right now, you could certainly go there. There also seems to be just a lot of structural changes worldwide in terms of demographics, in terms of technology that are also affecting these trends. It sounds like you're seeing that.
Well, we are. I mean, one of the reasons we've grown as much as we have, even though it's been slow growth, when I mentioned the $5 trillion addition to GDP in the last 11 years here, we have had population growth. Our population's about 10% higher over that time period. That's about triple what Europe has been. So I think that also helps explain the difficult situation in Europe. It's hard to grow an economy, as we see in Japan, when in the case of Japan, they actually are shrinking now. And in the case of Europe, much of Europe is actually shrinking from a population standpoint. So it makes growth hard to come by.
Let's kind of drill down a little bit then and talk about what does that mean for the small cap universe that you're investing in, that our listeners today are investing in. Give us some history. I know we've talked previously about the third quarter of 2011 and what that meant going forward. Give us some context then for the small cap world, Tom.
Well, the small cap stocks are very volatile. They're not as well followed. One of the reasons we like them, but they're not as well followed by investors, and so you really have to do a lot of homework. The third quarter of last year was an example of how bad things can be. Small cap stocks, just the broader Russell 2000 index, fell about 22% during that time. Now it's more than recovered that since then, and so that speaks to the volatility. But one of the things we see is, just thinking about the sector from a longer-term standpoint, they've outperformed large cap companies over the long run to the tune of about 2% per year, which doesn't sound like a lot, but you accrue that over multiple years, and it is a large number. And they've usually done it during periods of rising interest rates and rising inflation. So one of the things I think small caps may end up doing is, to the extent that those of your listeners that are worried about inflation, that they probably are a better hedge against that than large cap companies. There's a number of reasons for that, but historically that's been the case.
Now, I've put up a chart of, I know you have a few stocks that we could talk about today, and we've got about 10 minutes or so just to give you an idea of how much time we could spend on each stock. I put up the ticker JKHY, so anybody watching Tiger TV can see that. Tell us about this stock, Tom, what you're looking at here and how this fits into sort of the thesis that you've been discussing.
Sure. Jack Henry's one that's kind of in our backyard. I'm sitting here in Kansas City. It's in southwest Missouri. But it's a software company and services company that sells products into the banking industry, banks and credit unions. and historically smaller ones, but that's worked to larger ones over time. And they do, when you may be dealing with a small bank and you're doing bill pay, for example, you're literally paying your bills through an online through your bank account, and you may actually be interacting with their software that your bank bought from Jack Henry, or you may actually be dealing with an outsourced service. The bank maybe didn't buy, and increasingly this is the case, didn't buy the hardware and software. They're just buying a service provided by Jack Henry. And we think that's one of the things that will benefit the company over time, is that makes the level of recurring revenues, just almost think of them as subscriptions, business that you don't have to book and sell each quarter, that simply comes back to you as a continuation of the existing business. Upwards of 80% of the business, we think that makes it a little less risky and could make for a higher multiple on the stock. But one of the headwinds the company has seen over time is consolidation in the banking industry. And so we've gone in the last 20 years from around 15,000 FDIC-insured deposit institutions to around 7,500. Now, Jack Henry's done very well in that, but that was actually a headwind, and we think that, wouldn't say it's run its course, but it won't be quite as rapid in the future, and so we like their positioning.
Mm-hmm. Now, I'm just looking at some of the data for this, and I noticed that they did report a couple weeks ago, May 1st, and I'm just curious, for you as a fund manager, how do you trade around earnings if there's some kind of surprise in the report, either to the plus side or something disappointing in the report? Do you ever make any buy and sell decisions based on that? Would you add to a position or sell shares based on something in the report?
Well, we try to take more of a 3 to 5 year horizon and look out that far and buy companies that we think are positioned to do well because of some underlying driver. And so in this case, outsourcing of bank services. Small banks, to be able to compete with Bank of America, need Bank of America-like services, and they often get them from a company like Jack Henry. And so where we see that 3 to 5 year driver, we'll use that to find the company, and then we'll use the company's quarterly report just to confirm that it is happening the way we would expect it to. Now, if something seems to be wrong, and we watch over several quarters that maybe the company doesn't seem to be participating in what we see as this 3 to 5 year longer term trend, that'll cause us to then question ourselves internally: do we have the wrong company, or do we have the wrong driving trend? Maybe we've missed something. But typically, since our turnover is relatively low, typically we wouldn't make a trade based on that. We'd be really looking for confirmation as to why we bought the company in the first place.
Mm-hmm. And would you ever add to a position based on either fundamental news or the story or technicals?
Sure. Well, certainly on the fundamentals, if the stock were down and we thought it was just because of some short-term issue, you'll see that sometimes. This wouldn't be the case with Jack Henry, but say a company where there was an inventory issue or something like that. Over the long run, inventories are average. I mean, half the time they're above average, half the time they're below average. If a company ends up having a disappointment in inventory built, we know that would be worked off in the future. And if the same, 3 to 5 year driver that we bought the company for in the first place is still intact, and the stock was down, then we would use that as an opportunity to add to it. But again, keeping that longer term view in place, has certainly helped us.
Great. Good. This is great to know, I think, for the traders who are wondering or would just like to follow how the institutions make their decisions. I want to move on, because we've got a few more minutes, and I know we want to talk about TIBCO, TIBX. I've put that chart up on the screen.
Sure. TIBCO Software is certainly not a household name, but it's a company that businesses, and it spans the spectrum from casinos to retailers to manufacturers, software that companies use to manage what is typically called event processing or risk. So think of a casino that actually is tracking somebody's gaming, their play, and if maybe somebody hasn't been back to the casino as frequently as they used to, maybe they've lost interest, all of a sudden you get a coupon in the mail or you get an email coupon. That's an example of something maybe driven by that underlying software that you as the end user would never see, but the company is actually employing But one of the things that's really driving that business is the sheer increase in data volume, and we see that with what's taking place. A topic du jour probably is Facebook, and Facebook coming public. In 1 second, Facebook receives about 695,000 status updates. That's a tremendous amount of volume. Companies that are involved in social networking are trying to figure out how to use that data. Often, because it's a free service to the user, you've got to figure out typically an advertising way of making money from that. And the sheer amount of volume of data is really driving the database market. And so TIBCO is involved in that. We see that as having a very clear longer-term growth driver for the industry.
Okay, I'm going to move on. Let's go to Cracker Barrel. We've got about 2 minutes left here. So what's I want to get to your last stock as well. So tell us about Cracker Barrel.
Yeah, Cracker Barrel, many of your listeners would know, is kind of a Midwest and Southern restaurant, family-style restaurant chain. They recently fought off a dissident shareholder, which we think, who was trying to make changes both in terms of board composition and also direction of the firm. I think that's made the company much more focused. It's a good company to begin with, we believe. We think it's probably a little better company now. And we think their demographics are quite positive. The fastest growing part of the demographic in the U.S. is people in their late 50s through 60s. That tends to be who eats at Cracker Barrel.
And nice chart on this one. I tend to watch the charts, and I'm looking very nice chart action holding up despite the market pullback. Tom, let's talk about your pick here from the energy sector, GTLS.
Yeah, Chart Industries is a company that we like because of its role in the natural gas industry. Gas is very plentiful here, and it's very cheap, and so it's finding increased uses. And one of the ways you need to, one of the things you need to do to make it useful is liquefy it, along with other gases. But natural gas, to transport it, especially overseas, you need to shrink it to a smaller volume, and you take that gas to a liquid. So the company is involved in making things like vacuum-insulated pipe, heat exchangers, cold boxes, things that are used in that liquefaction process. And one of the reasons we think gas has a kind of a long headway is that it only emits about 55% of the carbon that coal does for the same amount of energy extracted. And so we think it will simply take share continually over time. And the amount of it here in the U.S. is massive. We won't run out, and we'll be liquefying a lot of it for a long time.
And I'm noticing there's some very good earnings estimates that Wall Street has on this one for the next couple of years. 51% earnings growth expected in 2012, 41% expected in 2013. So very interesting one to watch. And also, like a lot of these smaller companies, this one is a fairly recent IPO, went public back in 2006. So a lot of, Tom, thank you. We're out of time. I wish you could stay longer because this has been a great conversation, and I really enjoy your insight and would love to have you come back on the show sometime soon.
I'd love to do it, Kate. Enjoy being with you.
All right, Tom, thanks again. All right, everybody, great conversation there with Tom Lamming from the Scout Small Cap Growth Fund. Stick around, got one more segment here on the Small Cap Roundup. I'm Kate Stalter. We'll be right back after these messages.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit tfnn.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Rand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
I want to thank Tom Lamming for joining us. Really, I always enjoy speaking to the fund managers, hearing how they make their buy and sell decisions. I think, and he's very, very good at explaining how some of these trends, but both in terms of the fundamentals and some of the stories, such as the demographics on Cracker Barrel and what's going on in the natural gas industry that's driving some of the gains in some of those stocks that he's in. So terrific explanations. Really, really thank him for joining us today. I personally enjoy those discussions and find them very insightful for all small cap and low price stock investors. I'm hoping to get some of the institutional investors who are in some of these lower price names in the coming weeks and months. We'll bring some of those folks on. Okay, I put up a chart there of PSCH, which is the PowerShares S&P Healthcare, small cap healthcare ETF. This is interesting because I was just reading an article about this yesterday. Came across on one of my Google alerts. Now, one of the interesting things about the small cap healthcare space, you get a lot of the biotechs in there, and as I was talking about medical device makers like a Biomed earlier in the show, ABMD, you get a lot of these companies that could be M&A acquisition targets because some of the larger pharmaceuticals, larger medical device makers, even consumer products makers in some cases, you get the Johnson & Johnson, some of those companies, they need to continue to be having new products in their pipelines. So acquisition now is frequently the way that they can do this. So I was just taking a look here at some of the small cap names. Now, don't forget, the S&P 600, they use the definition of small cap as being under $3 billion. I tend to use in the newsletter the definition of being under $2 billion, though I will not sell a stock if it's performing well, if it does rise above that $2 billion threshold. So yeah, this one has, let me pull up a chart of one of the holdings in the PSCH ETF there. This is Questcor Pharmaceuticals, if I can get the ticker right, QCOR. And I know that a lot of longer-term growth investors are probably pretty familiar with this one. This has popped up on a lot of growth screens. Now, this is, I'm showing it to you there on a weekly chart. It's got a market cap of about $2.5 billion right now, moves about 1.8 million shares a day. Pulling back, getting support above the 10-week line. Let me show that to you on a daily chart, and you can see it right there at that 50-day moving average, getting some good support. So again, that's a good indicator of a stock continuing to hold up nicely even as the general market is showing deterioration. Let's see, I've got a minute here. I can give you another name. Cubist is another one of the holdings there that's in this particular ETF. Now, this one also is really kind of more perhaps on that edge between small cap, mid cap, depending how you want to look at it. $2.6 billion, moving about 716,000 shares a day. This one's consolidating. You can see it's below that 50-day line, well above that 200-day line. So that's okay. It's again, not a meltdown, not something that's really on my radar at this particular point, but not a disaster either. Analysts expect an earnings decline in 2012, but just moderate growth in 2013. Okay, we will be back on Thursday with the next edition of the Small Cap Roundup. Check out the newsletter, tfnn.com. Low price leaders, get on there, take a trial, check out the watch list, and be ready to buy when the next uptrend does emerge.